Real estate finance questions and answers is what we are reviewing tonight. So get ready for the class to help you prepare for your national real estate exam. It actually applies to all states, not just your particular state. So anywhere in the US that you are, these questions are for you. So last night we did one class. Hi, Max. Thanks for joining. We did one class. We did the review of finance topic, and then we did 15 questions. We are continuing with questions tonight. And at any time, type your questions or answers in the chat box so that I can help you out or answer them, and let me know that you're here. I love to acknowledge you. Okay, continuing with finance for real estate. The Federal Reserve's Regulation Z applies to which loans? A, all loans. B, all loans secured by real estate. C, all loans secured by a residence. Or D, all loans over 25. Type your answer in the chat for 7.16. Hopefully there isn't a delay today. I tried to see if I could get a faster internet, but it's not available in my area, unfortunately. So the answer here, no, the answer is C. Not all loans. There are commercial loans. It doesn't apply to that. It doesn't apply to other types of loans. So yes, good. I'm glad you changed it, Max. So it applies to all loans secured by real estate. So Regulations Z applies to all loans secured by a resident. It does not apply to commercial loans or to agricultural loans over $25,000. Its provision cover the disclosure of costs, the right to rescind the credit transaction, advertising credit offers, and penalties for noncompliance with the Act. The Federal Reserve Regulation Z. I'm glad you changed it. Number 17. If a particular loan falls under Regulation Z's right of rescission provision, what happens? A, the lender has the right to change the terms of the loan within a certain period. B, the lender has the right to accelerate repayment of the loan because of a change in the borrower's credit status. C, the borrower has the right to pay off the loan ahead of schedule with no penalty. Or D, the borrower has a limited right to cancel the transaction within a certain period. Okay, certain time, certain period. So what is the answer for 717? I'll give you a moment since Max is participating. I invite all of you to participate. The answer here is 717D. The borrower has a limited time to cancel the transaction within a certain period. So a borrower has a limited time to cancel the credit transaction, usually within 3 days of completion of the transaction. The right of rescission does not apply to residential mortgage transactions, that is, to mortgage loans used to finance the purchase of construction of a borrower's primary residence. So it deals with the resale of homes, and so not new construction. So purchase or construction of the borrower's primary residence. It does, however, apply to refinancing of mortgage loans and to home equity loans. State law require a rescission period and notice on first mortgage loan transactions as well. So first mortgage, So the borrower has a limited time to cancel a transaction within a certain period. So that certain period, so a borrower has a limited time to cancel the credit transaction, usually within 3 days of completion of the transaction. The right of rescission does not apply to residential mortgage transactions, that is, to mortgage loans used to finance the purchase of construction of the borrower's primary residence. So that's a little confusing because it's for residential transactions, however, not for new construction. It does, however, apply to refinancing of mortgage loans and to home equity loans. So state law may require a rescission period and notice on first mortgage loan transactions as well. All right. Number 18. Under the Equal Credit Opportunity Act, a lender or a real estate agent who assists a seller in qualifying a potential buyer may not what? A, tell a rejected loan applicant the reasons for the rejection. B, ask the buyer-borrower about his or her religion or national origin. C, ask the buyer-borrower to explain unconventional sources of income. Or D, use a credit report that has not been provided by the borrower. So Equal Credit Opportunity Act. So which one is not? Agent who assists the seller in qualifying may not, okay? May not, okay? No prejudice. 718B is correct. Ask the buyer borrower about his or her religion or national origin, right? That's one of the 7 protective classes. I mean, 2 of the 7 protected classes. Ooh, let's see here. Oops, I had it there. Okay, number 19. A conventional mortgage loan is one that is what? A, backed by the Federal National Mortgage Association. B, insured under Section 203B of the Federal Housing Administration FHA loan program. C, guaranteed by the government National Mortgage Association. Or D, not FHA insured or VA guaranteed. What kind of a loan is it? Conventional mortgage. So the answer here for 719 is D. It is not an FHA insured or VA guaranteed. Did I show answer for 17? There's 17, there's 18, and 19. I'm trying to see something else here. Okay, number 20. I was just going back to review some things. Oh, come on, 20. Okay, bear with me. I'm getting there. Oh, we had it. Number 20. The assumability of an FHA insured loan is A, unrestricted, B, limited by when the loan was originated, C, limited to owner-occupied properties, or D, prohibited on all existing loans under current regulations. So some loans are assumable. So which FHA loans can be assumable? Not all, some. It depends on the lender and what the terms were when the loan was taken. So the FHA insured loans, I'm sorry, I typed the wrong answer there. Pardon me. The answer here is B. You're right, Max. Is limited by when the loan was originated. Because the borrower has to live a certain number of years in the property before they can sell it. So it's limited by when the loan was originated. And it's also, so rules for assumability vary according to when the FHA insured loan was originated and whether the loan was for an investment property or an owner-occupied principal residence. Loans originated before December 1st, 1986 are generally assumable without restriction. Before December 1st, 1986. Loans originated after December 1st, 1986 require that the assumer show creditworthiness. Some mortgages executed from 1986 through 89 contain language that is not enforced as a result of later congressional action. Mortgages from that period are now freely assumable, despite any restrictions stated in the mortgage. So that was number 20. Okay. Okay, so the answer was correct. 720, Max. You're doing great, Max. Thank you for being here and participating. Okay, number 21. Number 21. A VA certificate of eligibility determines A, how long an individual served in the military, B, the maximum loan amount an approved lender can give to veterans, C, how much of a loan the VA will guarantee, or D, whether, hold on, I'm trying to change the screen, whether a lender is approved to issue VA guaranteed loans. So hopefully you remembered or watched the video from yesterday that went over all the FHA and VA information when it comes to financing. So the answer here is 721C. How much of a loan the VA will guarantee? Because remember, VA, Veteran Administration, guarantees loans, VA loans to veterans. Requires 0% down payment, even though borrowers can put a down payment. The closing costs are requested from the seller to contribute the closing costs for the borrower. If the seller does not want to do that, then they'll reject the offer, because it can be, I think, up to 6%, don't quote me, as far as closing costs. Let's see what the answer says. A veteran must apply for a certificate of eligibility. Remember that it's a certificate of eligibility that they then deliver to the lender that can do VA loans. to find out the certificate of eligibility, to find out how much the VA will guarantee in a particular situation. Number 22, a borrower obtains a 30-year fully amortizing mortgage loan of $450,000 at 8%. What is the principal balance at the end of the loan term? Okay, a borrower obtains a 30-year fully amortizing mortgage loan of $450,000 at 8%. What is the principal balance at the end of the loan term? That means at the end of the 30 years. What is the balance of the principal? Anyone? The answer here is D. It's 0, right? Because it says it's fully amortized mortgage loan of $450,000. A borrower obtains a 30-year fully amortizing mortgage loan of $450,000 at 8%. What is the principal balance at the end of the 30 years? The balance is 0. And then the lender provides a release of liens. And if they don't, it's up to the borrower to request it and a deed that conveys 100% of the title to the borrower. Because sometimes some lenders don't automatically provide it. So it's up to the borrower to make sure that they get it. Not all borrowers may know that, but that is what needs to be done. Okay, here. Today, these are a little bit challenging. Just bear with me. Here we go. Number 23. Oh, so let me make sure I show the answer. 722 was D. Which of the following describes a purchase money mortgage financing arrangement? What kind of a mortgage? A purchase money mortgage. So A bank gives a buyer a senior mortgage loan that fully covers the cost of purchasing the property. B, the buyer gives the seller a mortgage and a note as part of the purchase price of the property. C, a land trust holds title to the property while the buyer makes periodic installment payments to the seller. Or D, the seller uses the purchase money obtained from the buyer's mortgage loan to repay the seller's outstanding loan. So which of the following describes a purchase money mortgage financing arrangement? A, B, C, or D? So 723, the answer is B as in boy. The buyer gives, so purchase money mortgage is with the seller. They're taking back a certain percentage of the purchase price, whatever the lender did not approve. So the buyer gives the seller a mortgage and note as part of the purchase price of the property. The other promissory note goes to the principal mortgage, the primary mortgage, which is in first position, which is the lender. So it could be, way to go, Max. It could be an 80 or 90-10 type of loan, or 80% that the lender financed and the borrower, the lender allowed for subordinate loan in second position for 20%. It has to be approved by the lender. It's basically owner finance, seller carry back. Number 24. A homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for the loan. The homeowner retains title to the property. This is an example of an intermediation. An intermediation. B, forfeiture. C, hypothecation. Or D, subordination. So when you have a loan, homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for the loan. What is the borrower doing there? 724. The answer here is C, hypothecation or hypothecation. The process of securing a loan by pledging a property without giving up ownership of the property is called hypothecation. Okay, any questions so far? Next, number 25. Which of the following correctly describes the flow of money and documents in a mortgage loan transaction? A, the borrower gives the lender a note and a mortgage in exchange for loan funds. C, the lender gives the borrower a mortgage and receives a note in exchange for loan funds. C, the borrower receives a note in exchange for a mortgage loan from the lender. Or D, the lender gives the borrower a note, loan funds, and a mortgage. $725. The answer for 725 is A. The borrower gives the lender a note, the promissory note, which is not recorded, and a mortgage or a deed of trust in exchange for the loan funds. The lender doesn't give the borrower, the borrower a mortgage. They give him a loan, okay? And the mortgage is equivalent to a deed of trust in non-judicial states, and receives a note in exchange for loan funds. Well, they do receive a note, but they don't give the borrower a mortgage. They give them money. And C says the borrower receives a note in exchange for a mortgage from the lender. No, the borrower gives the lender a note. I promise to pay you, right, under these terms and this deadline, how many years? So then D, the lender gives the borrower a note, loan funds, and a mortgage. No. So the best answer here, the borrower gives the lender a note, the promissory note, and a mortgage in exchange for the loan funds. Number 26. Let's see what the answer says. When a borrower gives a note promising to repay the borrowed money and executes a mortgage on the real estate for which the money is being borrowed as security, the financing method is called mortgage financing. Number 26. In a deed of trust transaction, which of the following occurs? A, the beneficiary conveys title to a trustee in exchange for loan funds. B, the trustee conveys title to a beneficiary in exchange for loan funds. C, the trustor conveys title to a trustee in exchange for loan funds from the beneficiary. Or D, the trustee conveys title to a trustor in exchange for loan funds from the beneficiary. So who is the trustor? Who can answer that? Who is the trustor? 726C is the correct answer. The trustor conveys title to a trustee. The trustee keeps the title in exchange for loan funds from the beneficiary. The trustee is a neutral party that the bank entrusts to follow through with what is declared in the deed of trust. So the beneficiary, what is the lender? The trustee is the trustee for the lender, the beneficiary. The trustor is the borrower. And so the trustor conveys a title to the trustee who holds the title in exchange for the loan funds that were provided by the bank, the beneficiary. Number 27. A lender lends money to a homeowner and takes legal title to the property as collateral during the payoff period. They are in what kind of a state? A, title theory state, B, lien theory state, C, state allowing land trust, or D, state where hypothecation is legal. Sorry about that. So the lender lends money to a homeowner and takes legal title to the property as collateral. What kind of a state are they in? Ooh. Oh, I thought I had just seen you typed the answer, Max. All of a sudden, a 723 showed up. No, Max, it's in the state that you're in. You're in a title. I'm sorry. You're in a lien theory state. So a lender lends money to a homeowner and takes legal title to the property as collateral during the payoff period they are in. So states that regard the mortgage document as a conveyance of ownership from the mortgage or to the mortgagee are called title theory states. So this is a title theory state. So lender lends money to the homeowner and takes legal title. So the answer is A, as collateral during the payoff period. So many states, So states that regard the mortgage document as a conveyance of ownership from the mortgage or is the borrower, the mortgagee is the lender, to the mortgage. So states that regard the mortgage document as a conveyance of ownership from the mortgage or to the mortgagee are called title theory states. Number 28. A lender who charges a rate of interest in excess of legal limits is guilty of D, redlining, B, usury, C, profit taking, or D, nothing. There are no legal limits to interest rates. There are limits. So it's not D. The answer here is 728B, usury. So many states have laws against usury, which is the charging of excessive interest rates on loans. Such states have a maximum rate that is either a flat rate or a variable rate tied to an index, such as the prime lending rate. So those could be like amortization loans, where after the term of the ARM, amortization rate loan, expires, then the interest rate can vary according to the prime lending rate, tied to the index, such as the prime lending rate. So usury. Number 29, here we have a problem. A lender is charging 2.5%, 2.5 points on a $300,000 loan. The borrower must therefore pay the lender an advance amount of A, $3,600, B, $750, C, $7,500, or D, $6,000. So 2.5 points is equivalent to 2.5%. So 2.5% of the loan amount of $300,000. So what is 3 times 2.5? 75, right? And then you add the zeros because you're moving the decimal point to the left 2 points, 0.02. So on the 300,000, move the decimal point to the left 2. So you end up with 3,000 times 2.5 is 7,500. $750 is like way off. Okay. No way to even consider it. So you're multiplying 2.5 times 3. That's 775. And then add your zeros. So it's not $750. That's like nothing. So 1 point would be 3,000. 2 points would be 6,000. 3 points would be 9,000. So it's between 6,000 and 9,000, right? So the answer, 729, is C, as in Charlie. 7,500. That's what ends up costing the buyer lots of closing costs, and the closing costs can be quite high. Sometimes, oh my gosh, if 2.5 points of that, they could end up paying another 3% in closing costs or more, because they've got to pay 1 year of homeowners insurance, 2 to 3 months of property taxes to put into the escrow account, the points, if there's any origination fees, and then the title cost, their home inspection, and anything else that they've got to pay. And sometimes they'll have to pay interest. Yes, that's correct. 300,000 times 0.025, when you convert 2.5 into decimal, equals 7,500. Thank you, Max. Very good. Number 30. The difference between a balloon loan and an amortized loan is A, an amortized loan is paid off over the loan period. B, a balloon loan always has a shorter loan term. C, an amortized loan requires interest payments. Or D, a balloon loan must be retired in 5 years. So if a loan is stretched out for a term of a certain number of years, what would that be? A balloon says they have a loan for a certain number of years, but it doesn't get paid off. At the end of the term, boom, they have a humongous balance to pay, right? So 730 is A. An amortized loan is paid off over the loan period. Typical loans are 30 years. Do people still live in their homes for 30 years? Rarely. My parents, some of my brothers, they lived in their homes for that long. Others that relocated, and myself, no. Okay, I relocated so many times. I think the longest I've had a residence is 19 years. No, 17 years. So people move a lot because of job, marriage, divorce, death, career, military. Military move a lot. So why wouldn't it be C? Because not all amortized, it says an amortized loan requires interest payments. There are interest only loans, okay? But it's amortized loans is principal and interest. If it is an ARM loan, it is only interest and it's never, it's not paid off over the loan period, okay? There ends up being a large balloon payment at the end of whatever the loan period was. So an amortized loan requires interest payments. And let me see what the answer says. Amortized loans retire the principal balance over the loan period. If a loan does not do this, one must make a balloon payment at the end of the loan term to complete the loan payoff. So amortized loans, the majority of them do have interest. Actually, all of them have interest, okay? However, the key here is it doesn't necessarily, it's saying, what is the difference read the question. What is the difference between a balloon loan and an amortized loan? So C won't apply because it says amortized loan requires interest payment. Well, it does. But what is the difference between a balloon payment, a balloon loan, and an amortized loan? The amortized loan gets paid over the loan period. A balloon loan does not. A balloon loan gets paid at the end of a shorter term. So they pay principal and interest, let's say for 5 years. And at the end of 5 years, they have the large principal balance to pay off. Okay? They wanted to know the difference between those two, not whether an amortized loan requires interest payments or not. Whether it's a correct answer in general, yes, but it's not the correct answer for the question. Got it? Yes, you said you got it. Yeah, this got me for a moment. That's where read the question carefully. What is the question asking for? Okay. Number 31. I said we were only going to do up to 30, but I'm going to continue. A distinctive feature of a promissory note is that, so what is a promissory note, right? I promise to pay you back in certain terms. The distinctive feature of a promissory note is that A, it is not assignable. B, it must be accompanied by a mortgage. C, it is not, excuse me, it is a negotiable instrument. Or D, it may not be prepaid. So what is the answer for 731? So 731C, it is a negotiable instrument. So a promissory note, it is a negotiable instrument, which means payee may assign it to a third party. So A says it's not assignable. It is assignable. Okay, banks sell promissory notes and they sell it for less than what is owed. Investors will sell promissory notes or buy promissory notes that exist on a particular property, and they'll sell it for less. So then the investor who buys it has now the promissory note whatever term is left and hopefully a higher interest rate. That's why investors would buy notes. You hear about notes being sold. That's a promissory note that is being sold so that it is assignable. Okay. So then the assignee would then have the right to receive the borrower's periodic payments. So it is a negotiable instrument. D, it may not be prepaid. Some of them can be prepaid. Okay, there may be a penalty from the lender for the prepayment. And not all of them are accompanied by a mortgage. It could be an owner finance, or it could be some other type of note and exchange. The key word that triggered this one to be wrong is it must be accompanied by a mortgage. Did I show the answer? 731C. 732. When the terms of a mortgage loan are satisfied, the mortgagee, the lender, right? A, may retain an overage in the escrow account. B, may inspect the property before returning legal title. C, may be entitled to charge the borrower a small fee to close the loan. Or D, may be required to execute a release of mortgage document. So what is the answer for 732? The answer for 732 is D. The mortgagee, which is the lender, may be required to execute a release of mortgage document. It cannot retain the overage in the escrow account. That is what the borrower paid for property taxes and for insurance. That gets returned back to the borrower because it's a saving account. The escrow account is a savings account that the lender has for the borrower. That money belongs to the borrower. And they don't inspect the property before returning legal title. It's already been paid off. Mortgage loan has been satisfied. They don't need to go. They've got their money. They have nothing to lose. And may be entitled to charge the borrower a small fee to close the loan. No, they already closed the loan. They paid it off. Only if it was there was a penalty for prepayment would there be a small fee. But that's if. But the question says when the statement says when the term of the mortgage loan are satisfied, the terms of the mortgage loan are satisfied. So it's all paid off. Everything is paid off. There's a zero balance. Then the mortgagee may be required to execute a release of mortgage document. 732D. So lenders may be required to release the mortgage or trust document, the deed of trust, to the borrower when the borrower has paid off the loan and all other sums secured by the document. The release clause, also known as defeasance clause, remember that defeasance clause, may specify that the mortgagee will execute a satisfaction of mortgage, also known as a release of mortgage and mortgage discharge to the mortgagor, which is the borrower. So remember how it said borrower has two O's and mortgagor has two O's and lender has two E's and mortgagee has two E's. That's a great way to remember it, that they described that yesterday in the review. I hadn't heard it that way. I just remember OR and the EE, the giver and the receiver. Number 33. In addition to income and employment data and employment, in addition to income, credit, and employment data, a mortgage lender requires additional documentation, usually including A, an appraisal report, B, a criminal record report, C, a subordination agreement, or D, a default recourse waiver. Number 33. So in order for the lender to be totally satisfied that their investment to loan that money to the borrower on that property is protected, what do they need before closing to find out what the value is of that property? They need an appraisal report, which they send out an appraiser from the pool of appraisers that they have. So 733A, an appraisal report. They will also require a survey, but they don't talk about that on, it just says income, credit, and employment data. So there's additional document that they can require. 733A. An appraisal report. And again, those are estimates, right? 2, 3 different appraisers could come up with different estimates. Okay, that's not going to work. Number 34. The 3 overriding considerations of a lender's mortgage loan decision. Say the 3 overriding considerations of a lender's mortgage loan decision are A, points, interest rate, and loan term. B, the location of the mortgage property, the borrower's cash, and the amount of borrower's equity. C, the ability to repay, the value of the collateral, and the probability of profitability of the loan. Or D, the amount of the loan, the borrower's income, and the down payment. So the lender's got to make sure certain things are met for them in order to make the investment, right? They want an ROI. What's that? Return on investment. So that's one tip that I'm giving you. $734 is C as in Charlie. The ability to repay, the value of the collateral, which they find out from the appraisal, and the profitability of the loan, the interest rate. Okay, so the ability to pay, it's the credit report, the debt to income ratio, their credit, their employment data, all their expenses that deal with, remember the housing expense that is allowed 28% for conventional, and I think 43% for FHA and VA as far as housing expenses. So they need to know that, because the balance of that allows them to say, okay, I can loan that money if the maximum of their debt or expenses, household expenses, is 28% for conventional, or maybe 43% for FHA and VA. But they need to verify income. Is it from their job? Did they get a gift? How is the money that's in the bank that they're showing for their down payment? They have to prove their down payment, their credit history. Some loans typically want a score of 580, but some will go down to 500 with the requirement of putting a larger down. Could be 10%, 15%. They verify employment. For how many years have they had it? So that additional is an appraisal report. So I was just repeating what some of the things that they require. So the 3 overriding considerations that the underwriter will review: do they have the ability to pay? What is the collateral based on the appraisal? And are we making enough profit on this property with the interest rate and the term? That's why investors and business owners buy real estate, right? To get a return on their investment. And that's why I bought real estate, because I was an investor for quite a few years. Number 35. My craziest experience was owning an 8 apartment complex, a real old one, historic building that the loggers used to use. And behold, I didn't know that it was called the drug house and also a brothel in history, as the logging industry started dying out. So, but it was a very nice building at one point, and it had showers on the hallway. So we did a lot of improvements to that. So that was an experience compared to buying residential homes or duplex or fourplex. They have a tendency to be a cash cow, meaning if you keep them all occupied or just one vacant, it can bring in some really good money. So the goal is to increase the rents by improving the conditions of the home and decrease expenses and turning over the utilities to the tenants. So 35. So that's a little extra personal experience here. 735. The reason lenders consider the loan to value LTV ratio important in underwriting is that A, they don't want to lend borrowers more money than necessary. B, they want to ensure there is more than enough collateral to cover the loan amount. C, borrowers can only afford to borrow a portion of the entire purchase price. Or D, the higher the loan to value, the more profitable the loan. So what do lenders want to make sure? The reason lenders consider the loan to value ratio important. So the loan to value, the loan is maybe 80% of the value of the property, meaning the borrower is putting down 20%. FHA, they're loaning 96.5%. The borrower is paying a 3.5% down payment. VA, it's 100% financing guaranteed by Veterans Administration. So the reason why they consider the loan to value ratio important in underwriting is what? They don't want to lend borrowers any more money than necessary. B, they want to ensure there is more than enough collateral to cover the loan amount. C, borrowers can only afford to borrow a portion of the entire purchase. Nah. Or D, so I just gave you a hint. The higher the loan to value ratio, the more profitable the loan. Yes, that's interesting, Max. So 735, the answer is B as in boy. They want to ensure there is more than enough collateral to cover the loan. So the lower the loan amount that they're making, 80% or 7%, they have a lot of collateral. Okay, the higher the loan to value ratio, the more profitable the loan? No. So the higher the loan to rate ratio, that means like in an FHA, 96.5% to 100,000. Okay, they're taking a large risk, but that FHA loan is insured by mortgage insurance premium, right? Paid by whom? The borrower. Okay, so all insurance are paid by the borrower, even the PMI, property mortgage, private mortgage insurance on conventional loans that are less than 20% down. Okay, so that is it for tonight. We started out with question number 16 to 35. So we almost did what, 20? We did 19, 20 questions. And we'll have another session with finance questions and answers. and that'll be next Tuesday, unless I decide to go live again. My lives are Tuesday, Wednesday, and Thursday evenings at 6 p.m. Central Standard Time. And I review questions and review the topics. I review the answers of the questions and also vocabulary. And I did a series of math. So there's a playlist that has 2026 math series where I review the math section. That math section, the review here, didn't have actually working questions. So those types of, the review from the math shows up in national and state in different types of questions. Okay. And then you have the finance questions that are also workable problems, equations. So always make sure you read the question carefully, because even I screw up. Even sometimes while I'm doing the live, I've misread the question or mistyped or misstated an answer. That we don't know everything 100%. That's why they provide answers to the teachers or the tutors, just to make sure that we get them right. And sometimes the books are wrong. Okay, I have seen that. I'm not sure, Max, whether I will go live. I've got family coming into town, so I won't do it this weekend. Maybe Friday or Monday. Again, maybe, not committed. Okay, maybe. So I appreciate your asking and being here, Max. I'm trying to think that you made a comment yesterday that you were extending your exam again, or you had extended it already for 1 week. I didn't acknowledge your question yesterday. I was going through everything. So at any point that you have questions right after this video or anytime later on any of my videos, please type your questions. Let me know what you think of my teaching, my style, and if the reviews and the questions are helping you or what you need help on. Let me know. I'm here to help you, to guide you in passing that exam the first time or the second time. Majority of students don't pass the first time. So don't feel bad if you don't. There are a small percentage that pass the first time. They're very diligent. Everybody learns differently. Some learn audio, visual, or in person. So depending on your style, it might require studying more or studying in a very quiet place and being consistent with your schedule so that you can learn the material. I wouldn't recommend going to the big, thick books. Use the prep books. Watch videos. Watch my videos. Watch other YouTube videos. I'd rather you stay with mine, but I don't know everything. And for the state, I only deal with Texas. So if you're from another state like Max, he's in North Dakota, I can't help him on the state. I mean, I could look by the book and follow the book that way, but I don't have firsthand experience. There are other YouTube channels that do all 50 states. So their questions are combined, national and state. But they do for every 50 state. They do, 40 questions or 80 questions. And they do it every year. Okay, I focus on this particular book that I have permission to use. And there's a disclosure in the description. There's also a link in the description that you may purchase the book. They have it for quite a few of the states in the US that you can purchase it for. Any book that you purchase, Amazon will pay me a small commission. It doesn't cost you anything extra. I'm an affiliate of Amazon, and so they will pay me a small commission for that. And any other questions? I really appreciate you being here. Lets me know you're preparing and taking this seriously. And know that this is just the beginning. This is the easy part. Okay, because when you get out in the real world, it's challenging. It's a lot of work. Yeah, I recommend doing it full time, not part time. If you do it part time, it's do it evenings, do it weekends after your other job. You have to learn to work with your family, your other job, and real estate. Real estate is meant to be done full time in order to be very successful, because all brokerages are going to have their own training program that you must attend. Cloud-based companies, you'll do it online. So you do it at your own home, and that's how you run your business. You have to follow their policies and procedures on any brokerage. If you join a brick and mortar company, then you'll have to go into the office for the most of the part. Sometimes some of them do pre-recorded trainings, but they would prefer that you go in person to their live training and they guide you with everything. You get all the training. However, you will only succeed if the training is implemented and you're diligent, committed, and consistent and aggressive and assertive to take steps and let everybody know that you are now a licensed realtor and ready, willing, and able to help them with their sale or purchase of a property. You've got so much to learn once you start the business, because it is your business, not theirs. We have to follow the brokerage rules, the state rules, the national rules, the local MLS rules. Every state has their own association of realtors, National Association of Realtors. In order to be labeled as a realtor, we have to join the National Association of Realtors, your state association of realtors, and a local MLS. All those have fees. You pay a one-time fee January 1st for all three. If you join a brokerage and the MLS in the middle of the year, they'll prorate it. Then you have to pay an application fee to the broker, an application fee to MLS. Sometimes they may waive, the application fee from the broker. But starting out takes money, and you need at least $2,000 to $2,500 to keep your business going per year. That's minimum, especially if you're an independent broker, meaning you are not in a team. You might think, oh, it's going to cost me a lot of money to be in a team. And it is. However, they're going to teach you a lot. They're going to provide you a lot of tools. I mean, so is the broker, but a team has their own instructions, their own training, and they have the transaction coordinators that do all the paperwork. They follow up also with clients. You basically deal with the buyers and the sellers, and the support system of that team does everything else. They provide the signs, they provide the directionals for open houses, flyers, printing, the website, everything. The brokerage provides the website. Now, don't think that you're going to start a 100% transaction brokerage. You don't have the experience. That's for realtors that already have years of experience or have made quite a few transactions and have learned the business really quick. Then they go to a 100% transaction where you get 100% of your commission and you pay maybe $250 or $350 per transaction and something else per year. That is not for beginners. Okay, so next Saturday, not this coming Saturday, but the following. So I'm going to be dedicated and devoted on MLS and cold calling expired listing. Awesome. Cold calling can be scary. I don't like to do it. I have done it and gotten listings, but most of us have a lot of call reluctance, we call it, because we're going to get a lot of rejections. A lot of people aren't going to answer, or they're going to hang up on us, but it's an excellent way to get a lot of listings. The other way is by creating YouTube videos. You can get sellers, you can get buyers. There is so much to learn. Okay, so much to learn. So with that said, I greatly appreciate you being here tonight. And I thank you for your support to my channel, for my videos. I hope they're helping you. And again, please subscribe to my channel if you haven't, to support me and I continue making more videos and helping you. Give me a thumbs up if you like the video and click the bell so that you can be alerted anytime that I go live. I'm a realtor, Lillie Dominguez, in the San Antonio, Texas area. Actually, I can sell anywhere in Texas, but then I don't know the market in every area. So it's best to refer out any clients that are in another area, and that's what I have done. Our area has been expanded from San Antonio all the way to Austin. San Antonio with the metropolitan is like 2.5 million, and then Austin is even larger. So when we don't know the market, we can't do the best for our client. So it's best to refer them to another realtor and get a referral fee. Okay, you all. Thank you so much again. I love you and happy studying. Until next time.